Thanks very much for the introduction, Nancy, and thank you all very much for making your time available this morning to be here. Giving up the opportunities. I'm sure you would have had many to go and listen to budget speeches and analysis of budget speeches. I know the lawyers and the financial services companies, accountants have all been sending out lots of invites to analyze the budget. Quick welcome. I know there's some of the Growth Point non-exec directors here, Deputy Chairman Herman Mashaba, and then obviously all our business partners in various shapes and forms on the banking side. Very, very welcome here, and certainly also the investors. Very welcome here this morning. Just a quick note, there is apparently also a live teleconference feed if you want to, a number of analysts in London who will be listening in. I don't think they can see anything, but they can apparently hear. And we will also allow them to ask questions afterwards. It's a very full presentation, so there's lots to talk about, and I'm going to try and make it within the hour, and let's see how we go. All right, so we're trying to cover the period here, the 6-month period to 31 December 2010. I'm going to start off with a brief introduction and touch on some highlights. You've all got a hard copy of the presentation with you. Again, just for questions, if we can please leave questions till the end. I think just in terms of timing and getting through everything, we can keep the questions to the end. Secondly, we'll touch on the financial numbers. We'll look at the operational numbers. We'll look at disposals, developments and acquisitions during the period. I'll discuss the acquisition of the 50% interest in the V&A waterfront. And we'll look at the prospects then for the next 6 to 12 months. And then there are a whole bunch of annexures in the presentation as well, which give a lot of detail, which I won't be talking through, but they're there for your benefit. So just, again, a bit of a recap, who we are, what we are. We're the largest listed property company on the JSE today, with property assets valued at 38.6 billion. I think total assets, including non-property assets, for the first time exceeded 40 billion at 31 December. Market cap at that time, 31 December, was 28.8 billion. We have a diversified portfolio of property assets, 426 in South Africa and 33 in Australia. Our retail portfolio is valued at 11.5 billion. Office portfolio at 13.4, industrial at 7, and 100% of our Australian business is at 6.7 billion rand equivalent, just short of $1 billion Aussie dollars. And then probably still our key differentiating factor, albeit less so as many of the other property companies are looking to internalize management. We are the only what we call fully integrated, internally managed property fund on the JSE, with 448 staff across the country in offices in Sandton, Johannesburg, and Durban and Cape Town. And then obviously many of our staff actually reside at the building, so the shopping centres that we own, office parks, etc. as well. Highlights for the period, the distribution. I think that's probably what most people are really interested in, is the 8.1% up to 63.9 cents. We did increase our investment during the period in Australia. The original cost of our the cost of the original investment plus our further investment is now sitting at about 1.5 billion, and the market valuation based on the traded share price on the ASX is about 1.9 billion. We raised some new equity, 375 million, through the distribution reinvestment plan after our final results in June. We repaid 805 million rand worth of CMBS and essentially refinanced that through drawing down on conventional bank loans. We continue to have a favorable Moody's rating, investment grade. However, that is obviously under review at the moment, as most of you will be aware, pending the outcome of the ratings agency Moody's review of, I guess, the implementation of the transaction, as well as the final outcome as to how we end up funding that transaction. We entered the corporate debt market through the issue of a corporate bond in December last year, where we issued 500 million rand worth of notes, 4-year notes, and we achieved a margin there of 156 basis points over JIBAR. We remain included in the JSE Socially Responsible Investment Index. We also remain the most empowered property company for the 4th year on the trot. And the big news, I guess, more recently last week was the acquisition of 50% interest in the V&A with our partners there, the PIC and the Government Employees Pension Fund owning the other 50%, and our piece of the purchase consideration is 4.9 billion. On the distribution side, you can see, I guess, how it's moved between 2008, 29, 2010, and where we are today. We did mention at the year-end results last time around that we think we have turned the corner, that the trend in terms of growth rates decreasing or declining would turn, and that we would start looking at a growth in excess of the 5.8%. We weren't confident that we'd get to the double-digit numbers, and we've probably come in somewhere in between. If you look at the growth in assets and market cap, as well as the share price and net tangible asset value over the last 7 years since 2003, it's been a pretty busy period for us. And I guess with the latest purchase with the V&A, you know, that trend seems like it's going to continue. We get into the numbers. It's become quite hairy to put these numbers together, given the fact that we now have Australian numbers. We have to consolidate 100% of our investment there, and then take out essentially the minority piece that we don't own. So on a consolidated basis, the net property income grew at 10.4%, up to 1.638 billion from the 1.484 in the comparable period. Other operating expenses grew at 17.3%. It's obviously quite a small number. It's 61 million, up from the 52 million in the prior period. Mainly affected by the fact that Australia was only included for 5 months in the prior period, as well as there was some under accrual of certain expenses in the final numbers of the previous period. But you know, those were amounts 3 to 4 odd million, so nothing material. Net property income after operating expenses then grew at 10.1%. Our interest paid has pretty much stayed flat, if you want, and we'll talk more about that on later slides. Finance income down, mainly driven by the fact that we had raised quite a bit of equity in the prior comparable period with antecedent divestiture component in that 81 million. We take out the non-controlling interest for the Australian minority shareholders, and on a consolidated basis that then leaves us with growth at the distribution level of 9.7%. Now that doesn't quite translate to your 8.1% growth in distribution per unit, mainly because of the additional issue of some units with the capital we raised on the distribution reinvestment plan. Very busy slide, but detail on the income statement, and on this slide we show exactly the same numbers, but just splitting South Africa and Australia. On the South African side, net property income up 4.8%. I'll elaborate a bit more on that on the like-for-like on the next slide. And Australia up 57%, a combination of a number of acquisitions in Australia, and also the fact that Australia was only included for 5 months of the 6 months in the prior period. On the net property income after operating expense line, South Africa up 4.4%, Australia up 59.5%. Interest paid down in South Africa, but up in Australia. Again, on the Australian side, mainly attributable to the acquisitions that we made there, and I'll elaborate on that later. Finance income, not a meaningful number necessarily, leaving us with profit before debenture interest in South Africa up 6.4%, and in Australia up 71.7%. And if you then blend those and take out the minorities, you get to the 9.7% increase on a consolidated basis. In trying to analyze the net property income growth of the South African business, we start off with a 4.8% growth, and then we eliminate the impact of acquisitions and disposals, as well as the Investec lease. You may recall that Investec transaction was a very structured financial deal, and the increase in rent in terms of that lease for this period was only 3% on the Investec numbers. So if you eliminate the bulk of the impact really is attributable to the disposals. Like for like, then, net of the disposals, the actual income growth was 6.7%. Split between the 3 sectors, office sector grew at 5.4%, the retail at 8.6%, and the industrial at 6.1, giving you the blend of 6.7. Segmentally, we currently have around 30% of the consolidated net income coming from our retail portfolio, 484 million. About 35%, 572 million coming from the office portfolio. 20% from the industrial portfolio, 332 million. And then on a consolidated basis, 15.3% coming from Australia, 250 million. Property expense ratios for the three sectors, 28.4 in retail, 23.6 in office, 22.2 in industrial, 8.8 in Australia, and then consolidated 23%. The book values and the percentage contribution by value from the different sectors, 30-odd% retail, 35 office, 18 industrial, and Australia making up 17.4% of total assets. Bear in mind that is 100% of Australia. Balance sheet extracts, just a couple of numbers. Our direct property portfolio, just short of 32 billion, up 6.3% on the June numbers. Intangible assets, which still relates to the goodwill on the balance sheet when we did the management buy-in transaction in 2007. Long-term loans to our BE shareholders, 548 million. Cash on the balance sheet at the December balance sheet, 395 million consolidated. Interest-bearing liabilities, sorry, that's not consolidated, that's South Africa only. Interest-bearing liabilities, 10.6 billion. We have the non-controlling interest in Australia, 947 million, and then our NAV sitting at about 24 billion at the moment, up 7.6% from the December number. In Australia, the property portfolio, as I said, about 6.7 billion rand. There was quite a bit of cash on the balance sheet there, 127 million rand. Interest-bearing liabilities, 3.7 odd billion rand. We have 212 million units in issue in Australia. Some key statistics and ratios. Our property expense ratio compared to the June number, slightly up. Compared to the same period in December 2009, very much in line, 25.1. So I think we've been reasonably successful in keeping the expenses in check. On the operating expense side, 2.5%, up from 2.3%, and compared to the June number where it was 2.2. Total expense ratio now for the South African business at 27.6%, very much in line with the December 2009 comparable period, and slightly up on the June 2010. It is a trend that we've seen over the last couple of years, is that our interim number is always slightly ahead of the full year number. It's to do with the timing of increases in the number of our expenses. Interest cover ratio, very healthy, 3.2 times. Our bad debts, extremely low at 3.3 million. That's the charge through the income statement. Essentially made up of an increase in the provision of around just over 2.1 million. And then a write-down of some bad debts, net of recoveries of about 1.2 million. So very, very low numbers, and we're very, very pleased overall with our debtors position. Bad debts as a percentage of gross property revenue, very negligible, 0.2%. If you look at those same statistics and ratios for the Australian business, property expense ratio at 8.8%, operating expense ratio 5.1%, total expenses 13.9%. Interest cover ratio in Australia 2 times, and again bad debts for this period in Australia almost non-existent. Look at some of the balance sheet ratios. Our total arrears sitting at 41 million, that's up from 36 at June, but down from the 57 at the comparable December 2009 period. Again, as far as we're concerned, we're back to pre-financial crisis levels in our arrears. We do believe they're pretty much under control. Our provision for bad debt sitting at 17 million. NAV per linked unit up to 1530 from the 1444 at June. Net tangible asset value per share 1459. Our loan to value ratio on a consolidated basis, including Australia, sitting at 32.9%. And our loan to value ratio, excluding Australia for the South African business standalone, at again a very healthy 29%, below 30%. In Australia, total arrears 2.1 million rand. Provision for bad debts in rand 1.6 million. NAV per linked unit in Aussie dollars, $2.03, and the loan to value ratio for the Australian business sitting at 55.8%. Movement in the property portfolio. I think for this specific period, the activity was relatively low. Not much or nothing on the acquisition side. We sold 4 or 5 buildings to the value of 80 million, and we spent 290 million on development and capital expenditure. The fair value adjustment in terms of the valuation of the portfolio at December added 1.6 billion to the total, leaving a closing balance of just short of 32 billion, 31.9 billion. We have a number of properties, again, that are disclosed in the annexures that we hold for sale at the moment, valued at 482 million. And so if you're trying to reconcile the balance sheet, we've split those between long-term property assets and current assets. Borrowings and cash. I think very fortunate as Growthpoint that we continue to have access to significant additional bank funding. We repaid the 805 million CMBS, as previously mentioned, from other available facilities in August 2010. We don't really see the CMBS market as coming back yet. It's certainly operative, if you want to call it that, but in terms of pricing and liquidity in that specific asset class, it's not really an area where we see ourselves funding in the near term. We did the corporate bond issue. There seems to be and continues to be significant investor demand and oversubscription, as well as margin compression since the first issue of our CP program, our short-term commercial paper program in November 2009. Every time we have issued or refinanced some of those notes, we've seen a significant decrease in the margin that we pay. The most recent issue was 350 million in September 2010, where we got 33 basis points over. Look at the overall borrowings and cash position. Our current available debt facilities, about 10.2 billion. Utilized of that is about 9.65 billion, leaving us unutilized 571 million. We do have 3.6 billion rands worth of existing loans that need to be refinanced by 31 December 2011, and a bit of a breakdown of that. Firstly, there's an existing facility of 1.85 billion, which we have already refinanced through a new 1.3 billion facility with ABSA, and a 800 million facility with Standard Bank. The commercial paper issue, 400 million commercial paper issue, coming up in March 11. The intention there would be for us to refinance that again through the CP and just roll that for another 3 or 6 months. And then the biggest one being the 2 billion of CMBS issues coming up in August and September. And again, we have got facilities in place at the moment to refinance that, conventional banking facilities, and we haven't, I guess, quite made a final call on which facility we're going to be using there. Our interest rate risk policy remains at the board level that 75% of all interest rate exposure should be hedged at all times. We're currently sitting at 92.1% fixed, and as mentioned earlier on the balance sheet, we're sitting at 395 million of cash at 31 December. We do have some forward starting fixes which kick in on July 2011, which to the value of 2.1 billion, which would then essentially take us to back over 100% hedged, and therefore it is certainly our view and our approach that on a lot of the funding that we require for the V&A transaction, we would probably go floating rather than fixed. Right, operationally, very busy slide, but I always find this probably one of the most useful ones in understanding the overall property business of Growthpoint. 426 properties in South Africa, 33 in Australia. Our lettable area in South Africa just short of 4.5 million square meters. Our vacancy, 242 square meters across the sectors, 2.4% in retail, 8.1% in office, 5.5% in industrial, giving you a total for the business of 5.5%. Australia remains fully let. Property valuations, value per bulk square meter, you can see still very conservative valuations there, 11,800 value per square meter, excluding bulk for retail, 11,400 for office, and just below 3,000 for industrial. Average gross rentals, our forward yields on valuation, you can see still conservative, 8.5% retail, 8.8% office, and 9.9% in industrial. Average in-force escalations ranging between 7.8% and 9%. And the various, the weighted average lease periods as well, lease lengths if you want, 3.5 years in retail, 4.9 in office, and 3 in industrial. Some new statistics, I guess, that we've put in at the bottom of that slide. The renewal success rate. So these would be leases that come up for renewal in a given period. 80% of all leases were renewed successfully in the retail portfolio, 55% in the office portfolio, and 69% in the industrial portfolio, giving you an average of 69%. The renewal growth rate, which is the positive reversions on renewal. So if a tenant's lease expired at, let's say, at 100 Rand a square meter, on average through all of the renewals that we did, we got about a 4.9% uplift in rental in the retail portfolio, 5.3% uplift in office, and 7.1% uplift in industrial. And then the weighted average future escalation. So what escalation rates are we still getting in our leases when we renew these leases? Still at the between the 8 and 9% level, which is still very good and very encouraging. The reconciliation of our vacancy and total gross lettable area. We started off the period on the 1st of July with 6.4% vacancy, 288,000 square meters. There were a few adjustments. We then sold a number of properties, removing both vacancy as well as lettable area. There were some developments and extensions that we did during the period, just short of 8,000 square meters. Leases that actually expired in the 6-month period amounted to 382,000 square meters. The renewals and new lets that took place in the period added up to about 450,000 square meters. That was a combination of renewals amounting to 264,000 square meters and new lets of 194,000 squares. And then there were leases terminated for 43,000 square meters, giving us in our closing balance vacancy 242,000 squares, or 5.5% of the total. This graph just gives you a split then of the value of the South African property portfolio, office, retail, and industrial, as well as the regional diversification of the portfolio between Johannesburg, Western Cape, Pretoria, KZN, Eastern Cape, and Northwest. Next slide talks of the Australian property portfolio. I think that the key change there, post the acquisitions that we made in this 6-month period to December in Australia, we now also have included office properties in that portfolio. We had 2 office properties in the Brisbane area, and we made an acquisition of a standalone office property in Adelaide, which gives us by value now 18% exposure to the office market in Australia. Next 3 slides deal, I guess, individually with the 3 sectors, retail, office, and industrial. There's been a noticeable improvement in retail sales. I mean, everybody who follows the retailers obviously been tracking the performance of the retailers since the second quarter of 2010. Turnover growth at Growth Point shopping centres is tracking basically the national retail sales growth numbers. We have probably earned more turnover rental than we had budgeted. If I look at the 3 sectors where we are at the moment, year to date compared to budget for the full year, the retail portfolio is ahead of budget, more so than the other 2. Higher assessment rates are starting to impact negatively on renewal rentals, especially on the big box tenants. Our arrears are very much under control. Vacancy factor improved across the portfolio, and regional top centres are practically fully let. There's a little vacancy recon on the top right of that slide. You can see essentially the top 10 centre vacancy is 0.6%. For all practical purposes, that's fully let. The balance of our portfolio vacancy at 3.9%. undertook quite a few extensions and redevelopment projects during the period, which are progressing, and certainly those that are complete have done particularly well. Brooklyn Mall, Waterfall Mall, River Square, Colonnade, Northgate, and OK Mpangeni. At all of them, we have done some pretty decent refurb and extension. On 2 of them, mainly to facilitate Dis-Chem coming into the centres. And Dis-Chem historically have proved particularly successful as almost an anchor in shopping centre. The completed projects was the Brooklyn Dis-Chem. In Woodmead, we extended, or there's a property not part of the main shopping centre, but sort of on the fringe of the centre. We opened up a Geen and Richards store there. Colonnade Checkers extension, and then Warmer Park extension. Warmer Park was probably the most significant of the lot. We added just over 4,000 square meters there, again to accommodate Dis-Chem and a whole host of other retailers, and there was an extremely successful project. On the office side, just deal with the vacancy breakdown on the left, top left first. The core portfolio improved from 6.1% vacancy in December 09 to 7.3% at December 10. The development vacancies were 3.1% in December 09. They're currently at 0.8%. We've done particularly well on letting all those developments. Again, for all practical purposes, the new developments that we undertook leading into the financial crisis, I guess, and then that cost us a little bit in the 2009 set of results. Certainly, there we have done particularly well in de-risking and letting the bulk of those properties, giving us a total vacancy factor in the office portfolio now currently standing at 8.1%. Again, arrears are under control, 12 million of total arrears, and a provision of almost half that, 5.9 million. So vacancy levels remain under pressure though, but there are signs that there's an improved level of demand. Landlords are offering competitive rentals, substantial TI allowances, and low escalations and long rent-free periods. And that's the most competitive area that we find at the moment is certainly the office space. Tenants are playing off landlords' offerings against each other, and they're taking a lot longer to make their commitments. Albeit that our vacancy is sitting at about 8%, I believe we are well below the national average in the office space. So you might say that at 8%, there might not be that much competition, but I know that a number of our competitors in the office space are sitting at levels well into the double digit. We continue to focus on letting, and the continued focus has resulted in this decrease in vacancy. Some of the new developments are now 100% let. Lincoln on the Lake on the Umhlanga Ridge in Umhlanga, 6,700 square meters. That came on stream just as the financial crisis hit, and unfortunately it took a while to let that, but it's now fully let. The estuaries in Cape Town, in the Century City precinct, at 11,400 square meters, those properties are also now fully let. And then on the balance, there was quite a substantial vacancy reduction. So based on the progress in respect of letting the developments, there is a renewed focus internally on development, redevelopment, and refurbishment of existing core properties. And we have commenced a new office development on the Lelusha Ridge, Mayfair on the Lake, at about 6,500 square meters. And then we are well into the redevelopment of 160 Jan Smuts on Jan Smuts Avenue, and a very successful refurb in Autumn Road in Rivonia for both for Hewlett Packard, and subsequent to the refurb, we have successfully got Tourvest in there as a tenant. On the industrial side, trading conditions are improving marginally but remain tough. The recovery is still being led by the motor industry. Manufacturing and factory output data is not really providing any clear picture as to the recovery. One month it's up and the next month it's down. There seems to be a move away from manufacturing to warehousing and distribution. The whole toll issue, albeit it seems like that's now on hold for a while, but the nodes outside the toll area seem to be receiving a renewed level of focus. Industrial vacancies, although still high, appear to have stabilized and are certainly reducing. Rental growth remains under pressure, and the management of utilities continues to be critical, probably more so in the industrial sector than in the other sectors, where many of the users, obviously use quite a lot of electricity, and we all know what's happening to electricity costs and rates and taxes, etc. So in the short-term view, we think that the bottom of the cycle was between the second quarter and the third quarter of 2010. Tenant retention for us remains key. New development activity is improving, and net rentals remain under pressure, though, as a result of electricity, water rates, and insurance increases. The vacancy of the portfolio, we're currently sitting at a total in the industrial portfolio at 5.5%, pretty consistent with what it was at December 2009, but the interim between that, the June 10, obviously was quite a bit higher. Arrears, I think one of our key features here is the arrears in the industrial portfolio, whereas in December 2009, we had one or two properties where we had major liquidations. I think we had one of the other listed funds report last week. They seem to also have experienced two major liquidations, and we had that experience in 2009. As we sit here today, touch wood, we're looking okay, and the arrears are only sitting at 11.4 million in the industrial portfolio. On Australia, I mentioned the acquisition of the Property Solutions portfolio for $171 million, 7 properties. We financed that in Australia through a rights offer, raising $101 million. The balance was financed by debt. Growthpoint South Africa followed our rights to the extent of 55%, and then thereby diluting from our 76% holding to 67%. Besides those the two office buildings that were included in the Property Solutions portfolio, there were also 4 industrial properties in that portfolio, but we also bought the World Park single office in Adelaide for $49.5 million. The distribution to 31 December for the Australian business at 8.4 cents per unit. They also released their results, I think, 2 days ago. The rights issue units were separately listed, and they received 4.52 cents as a distribution. Post the payout of this distribution, the rights issue shares basically get delisted in Australia, and you default back to just one listed share. So the industrial market in Australia is expected to remain relatively neutral in the near term across most states. Across the eastern seaboard, the outlook for office property is reasonably strong. The effects of the devastating floods that hit Queensland, and the effects of the floods will probably will take a while, I guess, to filter through. It's relatively unknown, I guess, the medium to long-term impact of those floods in Australia. In terms of our own position, our 2 buildings that we own, the 2 office buildings, they were impacted. We had flood damage. The 2 basement levels of the parking were both flooded. And at the peak of the flood, I think we had about 20 centimeters of water in the ground floor basement of the building, or the ground floor, office of the building. Tenants were affected for about 7 days. They had to vacate. All in all, we insured, and we don't think that there will be any material financial impact on the performance of Australia as a result of those floods. The full year forecast for Australia remains unchanged at 17.1 cents. Disposals, developments, and acquisitions. On the disposal side, mainly industrial buildings, and then just a few residential buildings that remain in the Montclair development down in Cape Town. Total proceeds on sale 80 million, profit on cost 27.4 million, and profit on book value 2.7 million. Developments and maintenance capex. During the period, we spent 290 million. 102 million in the retail portfolio, 141 in office, and 47 in industrial. And the properties where we spent in excess of 10 million were essentially Warmer Park, 160 Jan Smuts, Autumn Road in Rivonia, Brooklyn Mall, Colonnade, and 11 Adley office in Cape Town CBD. In Australia, that's just the detail of the buildings that we bought in the Property Solutions portfolio, as well as the single asset in Adelaide. Right, V&A. I think last week we announced jointly, the PIC and ourselves, that we have acquired 100% of the seller's interest, the sellers being the London and Regional as well as Dubai World, essentially Istetmar. We bought 100% of their interest in Lexshell, which is the holding company for the V&A waterfront. The PIC and ourselves will jointly own 50% on completion of the transaction. There are currently BEE shareholders that own 25.05% of the shares in the V&A, and it is our intention to acquire their stake through mechanisms afforded the sellers in terms of the existing shareholders agreement. So certainly our intention to own 100% of the entire V&A after the transaction on completion. Again, it is our intention to structure the company as an unlisted variable rate loan stock company post the transaction through the introduction of your conventional share and debenture type capital structure. Currently, it's just a normal company. If we look at the brief overview of the developed portfolio, you have 383,000 square meters of developed property there, split between retail, just short of 90,000, office, just short of 90,000, hotels, 83,000, and then fishing and industrial, 122,000 square meters. The average base rental escalations through those sectors, 7.8 in retail, 8.7 in office. Hotels is really a bit of a mix in that a number of the hotel properties are essentially not owned by the V&A per se, but are let on long-term land leases to the operators. So One and Only is a good example. One and Only, you receive, as the owner of the V&A, you receive two rental streams. One is a land lease rental, and two is a turnover-related rental. But the actual construction, the bricks and mortar that you see there, 1.2 odd billion, I think, was the number that was spent by Curzon International, and that was their capital spend. Fishing and industrial, average escalations 8.9%. And then the weighted average lease expiry, you can see that there are a number of tenants in the V&A on extremely long leases in the office, hotel, and fishing industries. Very, very long leases. The V&A waterfront is a mixed-use property development around the historic Victorian Alfred Basins, which form Cape Town's original harbour. It's arguably South Africa's premier tourist destination with over 21 million visits there annually. It's got a mix of long-term retail and business tenants, and it's a unique location and a high-quality property. So we, as Growthpoint, bid in 2006 alongside, I think, probably 7 or 8 other bidders when Transnet put the asset on sale, and we really did pull out all the stops then to try and acquire the asset, but unfortunately we weren't successful. So to have a second bite at the cherry is we're very, very happy with being given that opportunity. The profile of the asset: it's a landmark South African asset. It's South Africa's premium tourist destination. It's a unique property asset that attracts tourists and visitors by itself. This allows the retail tenant mix to be less reliant on nationals and to be more focused on restaurants, curios, jewelry, and smaller line shops than would normally be the case. So when you start analyzing the numbers, you can't benchmark it. I know I can see Mohammed sitting there thinking, you know, how do these numbers stack up to Warmer Park and Brooklyn? They don't, because it is a very different asset. It attracts top international brands, which often launch their first store in South Africa at the V&A. So it's not comparable really to any of the other retail assets that we've got. I must say, in the week since announcing the acquisition, the level of interest from South African retailers who would want, you know, who are not in there at the moment, who want to be in, or who are in and who want a bigger footprint, has been quite overwhelming. The historic significance of the site, obviously there's a number of heritage sites there, and it still is an actual working harbour. We try and assess the impact of the V&A portfolio on Growthpoint and its sectoral makeup. If we look at the top left, that's the current GLA of the portfolio. The retail 23, office 23, fishing and industrial 29, hotel and leisure 21, berthing and common areas 2.7%, and then unallocated parking and storage making about 0.2%. By gross rental, approximately 60% of the gross rental comes from the retail portfolio. Just short of 20% from the office portfolio. Fishing and industrial makes up about 8.8% of the income, and just short of 12% coming from the hotel and leisure sector. If you then overlay that onto Growth Point at the bottom, and you look at our current makeup of rental between retail, office, and industrial, you can see it boosts our retail from 34% to 37%. Our office contribution would decrease from 42% to 39%, and our industrial would decrease from 24% to 22%. And including our piece of the V&A, approximately 2% of our income in future will then come from hotel and leisure type of activities. This slide just gives you a bit of a colourful representation of how the V&A is broken up into what they call 12 different precincts. So I'm not going to go into that, but it's relevant for some of the later slides. If we quickly look at the retail sector inside the V&A, it includes retail chains, local and international, fashion, design boutiques, specialty stores, restaurants, jewelers, taverns, and cinemas. The retail activities are spread amongst various buildings, the largest being the Victoria Wharf Shopping Centre. The craft market offers crafts, curios, accessories made by local artists. And then weighted by GLA in relation to retail buildings use at 31 March 2010, again it's slightly old, the information, but your average base rental there was 267 Rand a square meter. Your base escalation weighted by GLA was 7.8%. Weighted by gross rental was 8.6%. Your average operating rental was 52 Rand a square meter, and your average marketing was 12 Rand a square meter. The 90-odd thousand square meters at the V&A of retail is, as we said, 70 of the 88 is at the Victoria Wharf. And then you have about just short of 10,000 in the Pierhead precinct, 1,800 squares in the Portswood Ridge precinct, and 6,800 in the Clock Tower precinct. On the office side, your offices are primarily A-grade rated office buildings and include blue-chip tenants such as BOE, Nedbank, the BP head office, as well as Allan Gray. Locations are varied. Majority of the office space in the Portswood Ridge, Clock Tower, and Gateway Amsterdam Battery precincts. Again, weighted by GLA in terms of the office buildings at March 10, your average base rental was 128 Rand a square meter. Your base escalations by GLA was 8.7, and by gross rent was 8.6, and your average operating rent 12 Rand per square meter. You can see again the 89,000 square meters of office space spread across the different precincts. The biggest ones being Portswood Ridge, Clock Tower, and the Gateway Amsterdam Battery. Long-term leases, you can see from that lease expiry profile, you've got very, very long-term leases. On the hotel side, mentioned earlier, you've got a combination. You have owned hotels as well as land leases operated by some key independent operators. And the total hotel offering there represents some 1,500 rooms. Roughly 12% of the net property income of the V&A waterfront is earned from the hotel sector, of which 70% represents fixed rentals or base rental, and approximately 30% of that being turnover-related income. Again, you can see on the right-hand side the breakdown. The lease expiry profile is exceptionally long. The longest, that lease profile is obviously skewed by the very long land leases that are in existence. Onto the fishing and industrial sector. Fishing and industrial sector includes fishing tenants occupying the industrial buildings, yacht moorings on long and short-term leases, and leases to charter boat operators. The fishing and industrial property consists primarily of fish processing and freezing operations for key South African fishing operators. And if we look at the rental dynamics there by GLA, the average base rental sitting at 32 Rand a square meter. The base escalation weighted by GLA, 8.9%, and by gross rental, 8.7%. So I think if you analyze the four sectors, certainly the office and the industrial sector, if you look at those average rentals, by no means a stretch, they're not very full at all. The one that stands out a bit, that you need to get your head around a bit, is the retail. And as we said, there clearly is a very different retail offering. And if you look at the trading and the levels of trading and the trading densities that the retailers achieve in that particular center relative to our other centers across the country, it is significantly higher. And it is certainly our view that those rentals, albeit that they're on the full side, are definitely affordable if we analyze trading densities and rent to turnover ratios. There is, obviously, everybody is aware or has possibly heard of concerns around what they call the Link Mall, or the high-end fashion section. We were clearly aware of that as part of our due diligence. We, I guess, understand the dynamics there. Some of the guys trade better than one might appreciate, but that probably is the early focus in terms of our own involvement would be to analyze that specific mall and to see how one can improve there. Most of the leases there come up for renewal in 2012, and again, in our assessment of sustainable income, we have taken into account that you probably find some negative reversions on rentals in that mall. I guess one of the exciting aspects of this particular transaction is the unique development rights and the undeveloped bulk that exists. 603,000 square meters of bulk rights were approved by the Cape Town City Council, and 220,000 of that remains to be developed. The V&A residential, office and hotel bulk is arguably the most valuable bulk in South Africa due to its premier location. The V&A development rights also provide development flexibility in terms of land use rights and the timing of these developments. The existing contractual arrangements with the Cape Town City allows the transfer of bulk and the respective uses thereof between precincts. So there is a slide, I think it's the next one, which gives you an allocation of the bulk or a breakdown of the bulk per precinct and per use, being retail, office, etc. But there is quite a bit of flexibility in terms of the approvals. The urban planning process of the V&A is based on a unique process devised by the Cape Town City Council and the V&A, and that incorporates a hierarchical set of plans starting with general policies down to specific building plans. This slide gives you a table then of the total bulk, 220,000 spread across retail, office, hotel, residential and industrial. You can see quite a big component of the bulk, 98,000 relates to residential development. 23,000 retail, 56 office, another 38 for hotels, and 2,000 for industrial. The bulk and other non-income producing assets were valued at between 1.2 billion and 1.38 billion, which equates then to between 5,500 and 6,300 rand a square meter. The bulk has been valued based on a 12-year development period for residential. And there are currently 3 developments for which bulk has been earmarked. The first is Alan Gray office development. The second is a Holiday Inn Express hotel. And the third is a BMW Pavilion. There's a proposed development on the cards there. On the residential side, approximately 45% of the bulk is allocated to residential development. Between 2001 and 2009, the V&A built 518 residential units, averaging approximately 80 units per year, and after adjusting for the delay in residential development experienced in 2005 and 2006 due to the dispute in the Cape Town, dispute with the Cape Town City. The residential bulk has significant value due to the potential gross profit margin that can be achieved based on the premium selling prices. The selling prices in the V&A, arguably some of the highest selling prices that you get in the country for residential. Based on building costs of around 25,000 Rand a square meter and selling prices that we have done detailed due diligence on, we estimate that gross profit margins of at least 25 to 30% can be achieved on those residential sales. Look at a bit of a historic picture on the V&A. A lot of people have been asking, why the price has increased as much as it has from the original purchase price by the current owners. The rental income, or earnings before interest and tax, EBIT rather, over the last 5 years has virtually doubled. Over the last 4 years. compound growth rate, you can see that of over 20%. And that is if you take into account the 9 months actual to December 10, and you annualize that. The year end is 31 March. So in splitting the asset between the income producing assets, or value for the income producing assets, and value for the undeveloped bulk, we have attributed a value of just over 8 billion to the income producing assets, and that gives you a yield based on our assessment of the sustainable income there of around 7.2 to 7.3% yield on the income producing assets. Compare that to what the sellers might have earned, assuming the same value for the bulk. We've assumed around 1.2 billion for the bulk. There was no breakdown in 2006 given by the sellers as to what they paid for the bulk versus what they paid for the income producing assets. But if you assume the same 1.2 odd billion for the bulk, the income yield that the purchasers would have earned then in 2006 would have been somewhere between 4.6 and 5.3. So we're certainly buying it at a much higher yield at the moment, given the very good income growth that was experienced over the last 4 years. The V&A Waterfront has significantly improved top-line rental growth and profitability during the 4-year period due to a number of factors. I think firstly the focus on increasing fixed rents versus turnover rents on renewal of leases, increase in operating rentals to improve the cost recovery, focus on increasing recoveries through introduction of actual utility consumption to improve measurement and consumption, and then efficiencies from outsourcing security and cleaning. Bear in mind as well that a number of assets were added. If you look at what the original purchasers bought and the income that they were earning then compared to what we will be earning now, the one and only hotel hadn't been developed then, and the income in terms of the land lease rental and turnover rental that we earn now wasn't in the numbers then. The Link Mall hadn't been completed, so all the income on the Link Mall is additional income, as well as the breakwater, what is known as the breakwater parking garage. Look at our purchase consideration and yield. The breakdown of our purchase consideration, top left, as we said, 8 billion value for the developed property. There is a long-term loan on the Table Bay Hotel, which is the loan was made to Sun International, valued at 238 million. It's a commercial loan on commercial terms. We assessed the recoverability and the serviceability of that, and we believe that it's worth at least what it's on, at least its nominal value. And then, as I said, the estimated value of the bulk and other non-income producing assets at about 1.38 billion, giving you the total purchase price of 9.717 billion. If the earnings before interest and tax per Lexshall management accounts to December 2010 is annualized, and a growth rate of between 7 and 8% is assumed, which is consistent with the growth rates expected in the sector, the yield, as I said, on those income-producing assets at between 7.2 and 7.3%. If you break down the income and where it comes from, 59, or call it 60% from retail, 12% from hotel and leisure, 8.8 from fishing and industrial, and then just short of 20 from office. The different yields in valuing the income-producing assets, market-related yields that were applied in valuing them, 7% for retail, 8.7 for hotel and leisure, 9.5 for fishing and industrial, 8.3 for office. If you calculate at a weighted average yield, you get to about 7.7% based on those numbers. And then there, obviously from our side, there was call it a premium adjustment, which I guess you pay for that type of asset and that location, and the adjusted weighted average yield per our calculations at about 7.25%. So if the above yields, which were linked to most comparable yields at the time in the sector at the time of determining the price, are applied then to those various uses, then it is our view that we acquired the asset at probably a premium of somewhere between 6 and 7%, which we think is not unreasonable and is probably deemed appropriate for that type of asset. Our own funding and purchase consideration, we've got our contributions 4.9 billion. We have 5 billion of debt facilities that have been put in place. Mainly long-term bank debt facilities will be utilized. A portion of the initial funding will be refinanced using a combination of corporate bonds and new equity when appropriate. Assuming no new equity, Growthpoint's loan-to-value ratio will increase from 29% to approximately 40% in the short term. Whilst this might be higher than most other listed property companies, it's still well within Growthpoint's long-term target gearing range of between 40% and 50%. Moody's has placed Growthpoint on a ratings under review for possible downgrade, pending the implementation of the transaction and the final outcome of the funding mix adopted by Growthpoint. We expect transfer and completion probably mid to end April. So Growthpoint will endeavour to maintain a good investment grade rating and at the same time keep gearing levels at an acceptable level for the long-term benefit of linked unit holders and taking into account market conditions at the time. Right, we're almost at the end. Just 2 slides on prospects very briefly then. As the South African economy continues its recovery, albeit at a moderate pace, the underlying property fundamentals continue to improve. Improving property fundamentals in the form of increasing demand for quality space, an overall reduction in vacant space, stable and improving arrears and a reduction in bad debts, as well as a growing economy should improve the outlook for rental growth in the next 12 to 18 months. This positive outlook is, however, dampened by the continuing trend whereby administered costs in the form of electricity and rates and taxes are increasing at levels higher than the escalation rates embedded in our lease agreements, thereby putting pressure on our margins and making the total cost of occupation for our tenants less affordable. In these instances, it's often the landlord that has to compromise to ensure continued occupation of premises. With the outlook for rising interest rates as well as inflation, a commensurate increase in yields, cap rates and discount rates may well lead to a short-term softening in prices for both listed and direct property, with the former already evident since the beginning of the year. Listed property, I think, sector is probably down between 10 and 15% since the beginning of the year. Liquidity in the debt market remains at acceptable levels, with a slight improvements in margins still evident. However, the ability to raise capital in the equity market could come under pressure given the large amount of equity likely to be raised not only by new players in the markets via new listings, but also by existing participants. Growthpoint's focus in the short term would be to bed down the acquisition of its stake in the V&A waterfront and to ensure that appropriate management and reporting structures are in place to ensure that we not only maximize returns in terms of the existing V&A waterfront assets, but also start realizing some of the future value to be unlocked from developing the remainder of the 220,000 square meters of bulk. We expect to achieve growth in distributions for the full year similar to that achieved for the 6 months to December 2010, i.e. at the 8% level. And our auditors are sitting here. They haven't audited these numbers or that forecast. So, ladies and gents, I think that concludes the presentation. I thank you very much. There's a lot of detail there. All right, thanks again, everybody.